Hey, in this video, I'm going to talk about Employee Stock Purchase Plan, ESPP. So this one is an overview on the ESPP. I'm going to talk about what is an ESPP and what are those features and facts associated with this ESPP. First, what is an Employee Stock Purchase Plan, ESPP? An employee stock purchase plan is a type of stock option granted by the employee's corporation that enables the employee to purchase shares in the company stock at a fixed interval, which is the offering period. So first thing you need to know is ESPP is a stock option offered by employer to the employee. So they are a little different from other stock option is oftentimes this is accomplished through after-tax payroll deduction, which is different from the 401k plan, which is pre-tax deduction. So ESPP is after-tax payroll deduction used to purchase the stock option. So there's a common ESPP is qualified or non-qualified. Here we talk about qualified is for employee when they buy sell they may generate gains on those stocks. So when they are tax qualified, so those gains are treated differently in terms ordinary income or long-term capital gains. So those are called qualified. So when it's qualified is meet the requirement under the IRC code section 423. So non-qualified, so basically you don't have those tax favorable treatment. So this is actually from online. So information you can see for all the ESPP plan out there, 80% of those plans are under the section 423, and only 20% is non-qualified. However, no matter if you are, tax advisors, financial advisor, or you are plan participants, you just have to understand that all the plan ESPP are not the same. So some may be qualified, some may be non-qualified. So just understand those different type out there. For legal term, IRS, especially to use called statutory stock option. So when you is qualified under the section 423, so that they call is statutory stock option, which is qualified. Then this is provided by Fidelity on their website. Fidelity actually kind of acting like a plan advisor that help employers to design different ESPP plans. You can see here this is a common type ESPPs. There's 4 type of different things. You actually can go through create a ESPP through safe harbor plan, which is most cheaper, less impact to employer. I think it's less used, less beneficial to employee. Anyway, so most common type is this standard one. You can see is kind of cost employer a lot of money to use create this plan. So which means it's a beneficial for employee if you understand the tax implication, how to utilize this plan effectively. So you would definitely benefit from that because this is a good plan. So this is a standard plan. You can see 4 of them. First 3 are qualified, basically meet the tax requirement, I guess. the last one is non-qualified, so there's no tax favorable treatment. So just keep in mind there. So no matter who you are, you interested in this ESPP. So just keep in mind that there are many type out there. So when I am gonna talk about the section 4.2, 3 ESPP, which is qualified, the common type, and the tax implication, all the features, facts associated with it, and the tax implication with it. So, if you want to utilize this qualified plan, you have to meet the holding period requirement as a plan participant, which is the employees. So they require you to hold the stocks 2 years from starting the period, which is a granted date. You can say 2 years from granted date, 1 year from purchase date. So you have to meet the both of the holding requirement in order to be treated your income as a long-term capital gain. We all know long-term capital gain is much lower tax rate than your ordinary income tax rate, which is your salary tax rate. So then other feature common associated with ESPP is a 15% discount. This would give you an instant gain. So this is required by the tax code. The maximum permitted discount is 15%. So the company may do 5%, 10%, or 15%. So if they do 15%, so that's a very, very good deal to employees. Then look back period. This is a good beneficial feature to employees as well. This is reduce the risk of the stock dropping price at purchase. How it works is comparing the price at the beginning of the offering period to the price on the purchase date. Then applying the discount to the lower price. Basically, they usually have an offering period which is 3 to 6 months. Within this period, no one knows if the stock price is gonna go up or go down. So at the beginning, if you fix at the beginning purchase the stock price, when you purchase then the stock price dropped. So it's if you don't have this look back feature, you were stuck with the beginning higher price. So you bought at a higher price on the market, actually there's a lower price. So that's just how it works. Then the maximum you can get in each year is $25,000. So this is valued at the undiscounted stock price on the first day of the offering period. So that is without discount. The unused amount can be carried forward if offering period spans more than 1 year. So that's just something feature here. I may do a video just on a look back period because it's quite a little confusing. I'm gonna do a individual video just on the look back period, show you how you understand the benefit of it. Now I'm going to talk about a little tax implication here. As we talked about before, you have to meet the holding period in order to enjoy the long-term capital gain. But exactly how that works is exactly how that works is all the gains except the discount are taxed at the long-term capital gain. So I'm gonna do an individual video just on the tax. for you when you meet the requirement, holding period requirement, or when you're not meeting the requirement. I'm show you examples how it works. Here you just to know when you meet the requirement, you still have a little bit ordinary income tax, but however, it's the majority of the gains are going to be long-term capital gain if you meet the holding requirement. And if you are not meeting the holding requirement, that called disqualified disposition, only the gains after purchase capital gains can be short-term or long-term. So again, I'm just later gonna show you examples in another video. Just keep an eye on the other video. No tax withholding. So when you deduct, from your payroll to contribute, to purchase those stocks in these ESPP plans. So those deduction, you are not subject to any income or FICA tax withholding. That makes sense because it's after tax, contribution. There's no need to withhold tax. However, one thing need to know is when you sell the stocks at a gain, so you usually have ordinary income or long-term capital gains. So you are subject to income tax. However, you are not subject to FICA tax on those stock gains. So that's another benefit to you because any other money you make, you usually from your salaries or wages, you always subject to FICA tax, which is Social Security Medicare tax. However, this one, if have a gains, you do not have a FICA tax, especially if you hold the stock options that have a significant gains, so that just a huge benefit to you. So anyway, so this is just some overview on ESPPs. I'm gonna do another video on the look back, how it works. Then I'm gonna talk about all those tax implications, show some examples to dive deeper to understand how the tax works when you buy and sell the stocks in this ESPP plan.